We get a change in momentum, which is exactly what we're looking for. We get that change in momentum, and then we get a pullback into a premium area that we can then take a trade from, and then look how it flies afterwards. Something I used to get really wrong in my own trading was trusting that market structure is king, because this is kind of what you're taught, isn't it, by pretty much everyone you see on Instagram and YouTube, that market structure is king and you need to follow your market structure, and if you don't, you're going to lose.
King in the castle, king in the castle.
And whilst there's an element of truth in that, the way that I now trade, I can trade whether we are in bearish market structure, bullish market structure, or as I call it, momentum, because that is really all that matters, is where the momentum is in the marketplace. Is it moving in a bearish direction, or is it moving in a bullish direction? And therefore, can you line those things up to get yourself into good trades? There's one key thing missing. Liquidity is what controls the marketplace. Liquidity is where you're going to get your high value trades out of. Now, what I'm going to show you today is a really quick and easy way to prevent yourself from taking these bad trades. And by the end of it, you should be in a better place to make sure you're taking more profitable trades more regularly. For those of you interested in learning more about my strategy, jump onto my Instagram at StrongMoneyForex. And if you're not doing so already, please subscribe to the channel. It helps me out massively and I really appreciate the support. Thank you. So the first thing I want to kind of talk you through is just kind of the standard kind of market structure that everyone talks about. So it makes sense that you should be buying, when we're in these premium areas. Sorry, selling. It makes sense that we should be selling when we're in these premium areas, and then obviously buying when we're in the inverse of that. So buying when we're in these discount areas. And if you're not doing this already, this is something that I'd highly recommend. So for me, when I'm looking at my charts, I'm looking at where the trades are coming to and where the market is moving. Let's just say we've got a really nice trending structure, for example. Always draw out your range finder, and you should be looking for sells in this area here, which is what we call the premium area. If you're not doing that already, start doing it, and that in itself will just improve your trading. The inverse of that, of course, is discount, and again, you should be buying in discount. So many of us go wrong, and I used to make this mistake all the time, that we see the market come to here and then we get stopped out, and sometimes we take 2 or 3 positions before we actually catch the right position. Well, if you just simply wait, if you just wait until we're in these discount areas, and sometimes, you know what, it might do that and it might just shoot off without you, but that's okay. You don't really want to be getting in a trade like that, because often what happens is it's a weak move, and it's just a liquidity area that is then taken out. Price comes down, takes that liquidity into the discount. So as a good filter before you do anything else, buy from discount and sell from premium. And I'm not just talking about the bottom half and the top half. I'm talking about the bottom 25% and the top 25%. Now, in an ideal world, the market will move like this. However, as we know, if you've been trading for a little while, it doesn't often actually move like that. What it often does is something like this. And it means that often you can miss out on trades, and the reason why you're missing out on trades is because you're not factoring in, like we said, the liquidity of the marketplace. The liquidity of the marketplace is so important, and if you start factoring in the liquidity before you factor in market structure, then it can make these trades all the more profitable. Now, I've done a full video course on this. It's called my Liquidity Masterclass. You're welcome to go, if you go and have a look in my channel, you'll find it in the playlist, Liquidity Masterclass, and it goes into these different liquidity areas. This is what we would call an external liquidity level. It goes into that in a bit more detail, but that's for another video really. Today, what I want to do is I want to show you a couple of examples of where you can kind of be caught short in these moments. So let's have a quick look at this piece of price action here. Now, this is really recent, so we're making this video today, which is the 30th of July. You can see there's no replay tool on. This is the current range. Now, I like to use hourly ranges in line with kind of 15-minute ranges. So what I'm looking for is I'm looking for an hourly range like that. So that's my hourly range right now. So if we say the market is here right now, that's my hourly range right now. I'm happy that I'm going to be trading within that range. And then what I'm doing is I'm dropping down to the 15-minute time frame, and I'm looking for the most recent 15-minute range that I can trade within, which is that one there. Now the hourly ranges and the 15-minute ranges, I use them slightly differently. So hourly ranges give me an idea of where price might be headed to. For example, I'm happy buying or selling in an hourly range. It doesn't really make much difference to me because I can do whatever. But in a 15-minute range, I'm only ever selling from premium and buying from discount. Okay, I'm not doing anything else in the 15-minute ranges. In the hourly ranges, I can do whatever I want really. So although, you know, price is, let's say this was the range down here, for example, okay, then I would be happy, even though we're near the discount area of the hourly range, I would be happy taking a trade like that. And the reason being is that these hourly ranges, they're much slower moving. So you don't need to worry about premium discount too much. What they do is they give us a kind of a higher time frame picture of where the market might be headed. So for me, what I'm doing is I'm then looking at that 15-minute range, and then I'm actively waiting and, you know, seeing if price can come into these ranges before we can take a trade. Now, what you need to make sure that you're doing before you then enter a trade is you need to make sure that you're factoring in some kind of liquidity move first. So if you drop down to the lower time frame, okay, so many of us would have jumped into the trade here because we would have seen, we would have seen an Asian sweep, and we would have, you know, waited for price to kind of break down like that, jumped into the trade like that, and we would have been stopped out. The reason for that is twofold. Yes, you've had a liquidity sweep, but what you haven't had is you haven't had price come back into a premium level. So that premium level tells us that we can then start looking for shorts. So if you then start looking for shorts in that premium level, you're much more likely for these trades to play out. Now, when you're looking at this, again, same thing happens. You have this big push down. So many people jump into that straight away. They jump into that. They see that big push down. So they wait for maybe like a rejection pattern like that, stop above the high, and then they get stopped out. And why is that? Well, is there any liquidity to the left? Not really. Nothing of significance. Our key liquidity areas are that level there, okay? Or we look for its own internal liquidity. And what does price do? It takes out this liquidity here, drop down to the lower time frame. We then start getting a breakdown. It takes out liquidity again, then starts to break down. None of these are signals for me to get into the trade because at no stage have we changed momentum. The momentum right now, and I'll draw it out for you, is bullish, okay? So I have no reason to go short right now because all we're doing is making higher highs and higher lows. So this is where market structure should be used, in the sense of you should be using it to tell you where the momentum is. What you shouldn't be doing is using it just to trade on its own. And what you need is you need the liquidity. So what do we get here? We get a liquidity sweep here, and then finally we get this move down here, okay, which then takes out structure to the left. Now, it's not the greatest breaker structure. I did actually get in on this trade. It's not the greatest breaker structure. What you could have done is you could have waited for this second breaker structure here, but then you lose some of your RR. I was confident enough because of all the other factors that I was going to get into this trade, and it was a massive trade. I think I came out around here in the end, and I could have held it a lot longer, as you can see. We came out for about 4R, and what it meant is if we hadn't used that liquidity and just used market structure, there would have been so many false moves that we would have got into, like this move here, for example, and this move here. And what you need to start doing is you need to start putting liquidity at the forefront of your trading, because when you look at these markets and you look at and you try and kind of draw on your market structure, no market structure is as clean as we'd like it to be. We want the markets to move in a way that we're really happy with, but just look at this section of price here: down, pull back, down, pull back. Then is that a bullish breaker structure? Well, then we get this really kind of mucky bit down here, but ultimately then it breaks down again. Then we get, is that a bullish breaker structure? But then, it starts breaking down again. And this is where you need to use those ranges to really give you an idea, because as you can see from here, the price is all over the place and it doesn't really matter. All that we need to know is where the momentum is. Where is the momentum moving? Is it moving bullish or bearish? So all I'm doing personally is I'm looking at this section of price here, okay? and I'm drawing on my range from high to the low, and I'm waiting for them price to get to a key liquidity area, which is either this one, which is what I call range liquidity. Again, check out the liquidity masterclass if you want to know a bit more information on that, or this one, which is the external liquidity. Again, so many of you would have, let's say you were trading bearish market structure, you would have seen that, and then you would have entered short, and you would have just, gone and hoped for the best, and it wouldn't have worked, because what we need to see is we need to see a reaction to that liquidity. We need to see a breakdown from that liquidity first. Then when we get that change in momentum, because now our internal range has changed bearish, that's when we can get into the trade. So market structure works to an extent, but not on its own. As soon as you start factoring in liquidity and ranges, that's where it can change everything. Look at this section of price here. So this is our range down here. Okay, you would have missed that trade, and that's totally okay. Okay, that might happen from time to time, but then the next time when that happens and you miss that trade, it's kind of mucky price action. You don't really get anything out of it. However, this trade here, which has come back into premium pricing, we could have got into. Sorry, not that trade there. This trade here. But this trade here, which has got it back into premium pricing, you've could have got into that safely knowing that we've cleared out liquidity to the left, we've had a breakdown, we've got a range, we've tagged back into the premium pricing area, and then on the lower time frame you could have found an entry, and then look how great that trade is. So what you've got to do is you've got to start factoring in these liquidity points, because that move there was generated, and sometimes it takes a bit of a breakdown before you actually get the trade, but that move there was generated by Asia taking out the liquidity from the previous day. Okay, Asia's taking out liquidity. Okay, right now what are we? Well, we're bullish momentum, everything is moving bullish. Okay, after that liquidity clearance, we then get a weak push, then a pullback, then a strong push, and then a pullback into discount. So now you can get into your trade. And again, so many of us, what we're doing is we're expecting price to come down. So we look at this range here and we expect price to come down. So you enter like that and you get stopped out. And then you think, well, the next one will be okay, and then you get stopped out. Okay, and you might have been okay on the third one, as you can see, but you haven't got that confirmation. And if you do this over and over again, you're going to be losing over and over again. So factor in liquidity first. It's the first thing we want to see. We want to see a key liquidity area. That is external liquidity. That external liquidity has been swept. Then we get a nice breakdown in London. We get a change in momentum, which is exactly what we're looking for. We get that change in momentum, and then we get a pullback into a premium area that we can then take a trade from, and then look how it flies afterwards. Look how weak these moves are until we get this setup, because now we know that we're in bearish momentum, then we can trade it all the way down. So if you found this video helpful, please subscribe to the channel. Any questions you have, jump over onto my Instagram at strongmoneyforex, and if you'd like to find out more about mentorship with me, then drop me a message on Instagram and I'll be happy to talk you through the packages that I offer. Cheers.